to you, Wesley. Take it off.
Thank you, Fred. I'll begin with a short introduction of who we are. In research, sitting in this audience is Stella Okay, who covers, she's our in-house economist looking at macroeconomics and fixed income and what happens within that space. Then we have Melody Ndanu, who looks into the banking space and the nitty-gritties and drivers of the industry. And myself, I look at the non-financial sectors, all the way from telco to manufacturing. Receive our apologies from Eric. We had another meeting that he needed to sit into, but I believe we will cover it up for him. As far as Standard Investment Bank is considered, it's one of the largest, actually the largest investment bank in Kenya by head count. Today, it celebrated its 30th birthday, which means it's been in operation since circa 1995. Thank you. Our product ranges from research and sustainability, where we sit, where we give guidance into the investment space, into the market, and look into deal and advisory projects within the sustainability space. Corporate finance is another product that we offer on business restructuring, capital raising, and enterprise that are looking into either doing some activity within the public or the private space. Fixed income trading and equity trading is key within this the sell side part of the business. And on the other end of the business, we have global markets where they look into the special investment schemes with our flagship product being Mansa X with the highest return, one of the highest returns in the market. And in the spirit of inclusivity, last year, towards the tail end of 2023, give or take a bit, the company started Sharia compliant investments, which all looks within the local capital market and also external opportunities within the Sharia compliance space. And jumping straight into it, into the stock market and what we see, maybe a small recap of what we saw last year. Last year was quite an interesting year with the benchmark returning 34%. That means the stock market was the winner of the year, outdoing fixed income space, albeit recovering from the lags it printed from 2023 to 2024. Just to give you some sort of an understanding and the backdrop to the performance, we had 2020, which was the year COVID-19 struck, and we saw a lot of investor sell-offs, which drove prices down to discount. Then 2021, there was some sort of recovery with the adaptation, or rather investors gearing towards the new normal of living with this pandemic. And the market closed, albeit on an upward trend, with the story being lack of any bad news. Lack of any more bad news is good news. That was the story of 2021. Then came Russia-Ukraine crisis, the cataclysmic shakeup in 2022, give or take a bit. And it threw the whole global markets into a frenzy. Inflation started rising up globally. There was the geopolitical tension, and even this war spilling over to sectors like freight, which led to very stubborn core inflation globally. That was 2022, and it spilled over to 2023. And 2022, 2023 were two interesting years because the only difference between these 2 years was the calendar, but the macro play was pretty much the same. Then we came into 2024, a very interesting year it was. Globally, almost half of the global population was going into elections, be it presidential, be it or whatever parliamentary. There was a lot of election going on, and it was critical because of the geopolitical divide that we are seeing globally. And the main reason I'm focusing on this global trend is because from an activity point of view, the Nairobi Securities Exchange, in the Nairobi Securities Exchange, foreign investors account for about 60% of total market activity. So whatever happens in their home market might drive prices locally that is not a reflection of what is happening actually on the ground. Case in point, the discount levels that we saw in 2023, we had key blue chips touching multi-years lows, likes of Safaricom, KCB Group, Cobank, Bamburi, Equity, BAT, EABL, among many more. And the thing that was interesting is the prices were going down, but then the companies were more stable than before. The companies were larger than before. We had more in-tuned management coming in with a strategy. So the companies were performing at a better vantage point. But then it was not reflecting on the prices. And what we saw was opportunity, and that led to the recommendation we gave last year. But now coming into 2025, it's quite an interesting space. Looking at the telecommunication sector, for instance, which is a sector that accounts on a good day about 45% of the total market capitalization of NSE, and on the heydays, as high as 65% of the total market capitalization of NSE. So this is a crucial sector. In terms of the fundamental views of this sector, it's a very solid sector. Network rollout, very stable network rollout in the country by Safaricom. But then beyond the company specific, looking at the whole sectoral play, there is in depth in terms of network penetration. We have about 68.3% penetration of smartphone devices into the network. And now within the Kenyan telecommunication space, we have more smartphones than feature phones. This means that data consumption in the long run should be higher. Usage of Internet of Things, and also uh, the use of voice over internet protocols and the like should offset the traditional trends that we've seen in voice calls, for instance. Right now, I'd assume maybe 10 years down the line, more people will be doing WhatsApp calls, Skype, or even Zoom than they do of the traditional phone calls that we used to see. And also messaging is quickly shifting from the SMS into messaging through these top tech platforms, WhatsApp, your Twitter, your all this kind of over the top tech technology. Communication is shifting to that end, and this means revenues that were traditionally seen from voice and SMS should mature downwards as voice as mobile data picks up. And this was the assumption that we had. It's in line with global trends, with the likes of GSMA, which is a lobby body for telecommunicators globally. This is something that they were expecting to see, and it's totally in line with expectation. But then we've had recent concerns with satellite internet providers coming into the market. We saw on the fixed internet side, Starlink launching the internet product. It had very high consumer uptake, and it brought about some price wars between Starlink and the traditional fiber optic service providers, with Safaricom actually upping up their allocations vis-a-vis lowering down prices, which still it's costing they're incurring some element of additional cost, not from a pricing perspective, but from a utility perspective. But then this trend that showed within the fixed data services is expected to extrapolate into the mobile data services. We've seen these providers going to look for what we call the D2D licenses, direct to device, where you don't need any hardware to connect to internet services. You just log in through your phone and you get all these services. Now, as opposed to having a SIM card to get data, you can just log in into your Starlink account and you get your subscription coming directly from your phone. And we see this disruption really being key in the sector, also with the negative publicity around data privacy, and which we think will affect companies' brand and financial long term, with customer attrition being a key trend in the long run. So, in the long run, this is a sector that we're seeing a lot of maturity in the Kenyan space, but in the near term, uh, closing it down to Safaricom, it remains very a very good business, a cash cow with stable network connectivity on the GSM business. It remains a key market player with almost, give or take, about 70% of the market share across all its products. So it is a very stable business in Kenya. And Ethiopia, when they went out to Ethiopia, the market was really excited and actually priced Ethiopia at around 15 shilling, which was half the value of the Kenyan business at the time. And news on the political instability, so that aspect of premiumization come down to the levels that we are today at around the 10 shilling. But then the business in Ethiopia is more stable right now. They have taken the expertise, some of the best expertise into Ethiopia. Michael Joseph coming from Kenya to sit into the board of Ethiopia to really spearhead that businesses, how they actually set up the business in Ethiopia, very solid. And from a telecommunication point of view, it's interesting that the opportunities that lie in that market are very, very big, with almost 80% of the population being offline and 20% being online, implying that only 20% of the population use these mobile data services. I mean, those are the people who will be using bundles data. So as mobile device penetration gets into the market, there's a lot of revenues to be unlocked from data. Again, uh, they're having a very strong 4G and 3G rollout in that market, which means customers are consuming more data than any other product. And it's interesting because data is something that you can consume on your own. But as more people come into the service, into their service, you'd find they'll be able to now call each other within the on-net services. So as they attract people with data, you expect them to now realize more of SMS and voice as they build that critical mass. So a lot of opportunities in that market. It goes without saying mobile money is the key thing in that market, with almost 90% of all small cash transactions, of all small transactions being done in cash. So they have a lot of opportunities to unlock in terms of mobile money, but the caveat remains the heavy requirements of agent rollout, customer education, and the need for very low transaction costs. Potential risks, as I mentioned earlier on, remain the internet service providers, maturities within the mobile revenues with transaction charges coming, transaction charges as more transaction move towards cash. Last year we saw them trying to increase the excess duty on mobile money. It was not successful with the financial year 2024 going down, which I believe Stella will speak to into more detail later on. But then again, there was that news of converting mobile money till to tax registers. And that news alone, by the numbers we're getting from CBK for December, we saw a lot of cash building up in terms of transactions, which we think will affect the sector long term. Moving into the energy sector, this is a very niche sector and very interesting players in this sector. It's a sector that has remained blue chip in the sense that it's already in the news in terms of green energy drive, with almost 90% of the energy produced in Kenya being green. And Kenyan with geothermal connectivity leads the way. And we believe that with them moving into this green space, it will really see ahead more revenues from that aspect of uh, carbon credits coming along. And the more we see the sector going green, the more we believe Kenyan will get thought leadership in terms of geothermal connectivity in Africa and get more contracts outside of the Kenyan market, which is diversification in terms of their revenue. Again, we've seen them moving into more technologically advanced, projects like the battery energy storage system, which is an interesting play because the biggest issue with power globally is the fact that you cannot store it. You produce to use, but you cannot store power. So with them trying to to balance off with the more unstable power production sources like hydro, wind, and solar, which are on and off. You get oversupply during off-peak hours that you just have to switch off the connectivity to the grid. But then with this battery supply, it will aid with that load balancing and also provide a little bit of stability in terms of power supply, and which is a very, very key positive. And we were discussing in the office yesterday on the project that they're doing of around 100 megawatts in the hydro plants. And we think that, hydro is quite an interesting electric generation play in the sense that you rely on water, but then the availability of water varies. There's a time you find, let's say you have flash floods, you have to release a lot of water. There's a time you have uh, to hold water back to prevent flooding downstream. But with this battery energy storage system, they can have a constant energy generation on peak and off peak. The excess is being stored with the batteries during off peak hours, then released to the grid during on peak hours. And that stability will be very key, even in terms of reliability of power in Kenya. The caveat remains the capital expenditure that it will require, which also speaks to the initiative of looking into brine and the possibility of mining silica from it. Capex remains the key headwind for the company, but in terms of uh, its outlook, we're very, very positive with Kenya. On KPLC, it is an interesting business. It surprised most in FY24 with the with the finance cost play. That's why the company jumped in terms of profitability, at least from a P&L perspective. But this did not reflect on cash, with cash flows actually declining. We received the half-year results for the financial year 2025, and interestingly, profitability from the P&L perspective remained strong. But then again, it was tailwind by the FX play with the shilling remaining stable across this financial period. But then on the cash flow end, the business actually uh, uh, had lower cash flows within the financial year than the previous financial year. So there is a big conundrum with what's happening in the company. They're reporting on the P&L uh, account adjusted numbers, but that does not, but do not reflect in the cash that they received within the period, most of from operation. But with the business being primarily driven by power sales, because they have that ability to pass on extra costs to consumers that relate to power generation. So it means it's revenue neutral in the sense that it's not affected by inflation, it's not affected by FX translation. So they only get revenue for what the power that they sold. If the foreign currency plays on the negative, they pass it on. If it plays on the positive, they pass it on. So they don't profit from FX or inflation. It's just a revenue neutral top line, and which is a positive because we expect us in the long run as power consumption increases in Kenya, they should generate more cash. And with them being a capex like business, this means most of it will flow into the bottom line and seeing better dividend disbursement in future. And also with the 80% requirement by government for parastatal to release earnings and dividend, this is a good prospect for investors who are looking to the energy for both Kenya Power and Kenya. The manufacturing sector is quite interesting. Alcoholic beverage sector is seeing disruption globally. When you look at the beer portfolio, uh, craft beers started the disruption with consumers moving away from the traditional branded beers to in-house beers. And it's a trend that has even grown in Nairobi that I think most of the major clubs have their own craft beer selling. And this really affects the consumption of traditional beer. But then the fact that most of the traditional beers in Kenya are not drunk in these high-end clubs, but in the rest of the club, that disruption has not hit EABL yet. But then again, the company has remained very innovative. They set up a microbrewery in their KBL plant. We had the privilege of visiting it last year, and it's a small brewery where they experiment on new flavors. just to combat this disruption from craft beer. And it has worked with new brands like Manyata picking up in the market very well. And the seeders, they're experimenting with seeders 24/7. And we think this thought leadership should maintain their dominant position within the beer portfolio in Kenya. Moving on to the spirit brands, there's a study that was done in the US showing that there's a correlation between alcohol consumption and cancer. And from that point, there were reports that Gen Z and millennials were actually reducing their alcohol consumption globally. So, with that fact in mind, the high alcohol by volume spirit brands, talking about your whiskeys, your brandies, your tequilas, your rums, the consumption globally is expected to mature as consumers move from those high alcohol by volume drinks to ready to drink cocktails. These are the likes of your Smirnoff Ice. I mean, rather than consuming 40%, they've just done a perfect mix for you to consume it at 6%. So you'd find consumers will be moving towards this. But then the question remains, is the market ready for this consumer disruption? For EABL, we think so. They have on the spirit brands a lot of thought leadership coming in from Diageo globally. Because when you look at the alcoholic beverage sector globally, you only have two key players: AB InBev with the beer portfolio, Diageo with the spirit portfolio. Now, with those years of experience that Diageo is bringing with the spirit portfolio, EABL should be just fine. More so for brands that they cannot do drink cocktail, you expect to see some royalty agreement where Diageo brings its expertise to do this for the high-end brands, then they get a royalty agreement as they do in other markets. So at the moment, our recommendation on EABL is a hold. But what's worth noting is we're looking at the key shareholder trend. Uh, Diageo has been exiting its beer portfolio globally. I think the only beer brand it remains is its Guinness. But then again, in terms of the sale of Guinness, they have been getting rid of that portfolio from an ownership point of view to a royalty point of view. They exited Guinness Nigeria, Guinness Ghana, Nigeria being the latest one, I think almost 2 weeks back. That's when they announced the exit. And speculation is they only left with two publicly listed counters in Africa. That's one in Seychelles and EABL. And the speculation that we have in the moment is there's a high probability that their global strategy of focusing on their rich spirit portfolio and running an asset-like business and being very capex heavy, there's a possibility that they may be willing to sell the EBL stake. And we believe investors who align themselves strategically may be able to unlock premiums of up to 100%, depending on the contract that they will get with a willing buyer. And we've seen Castel picking up most of the Diageo portfolio within the sub-Saharan Africa. So as much as it's a whole for speculative investors, it's a very strong buy, counting on Diageo's eggs. And I mean, last year we had Bamburi. This year we might as well have EBL. It's a very long call, but I think it's one that can reward handsomely in the long run. Looking at the tobacco industry in Kenya, the biggest issue remains illicit with a market share of around 27. That means out of every 10 cigarettes sold in Kenya, 3 are illicit. And that's a very, very big concern because you find illicit is eating into the market share and top line and even margin of the market players, because you find the set market players are paying excess duty, the set market players are paying very heavy distribution costs. So when you look at it from this perspective, it's like an unfair playing field. But then that with that tax element of what the government is missing, we think the government might be more inclined in fixing the issues within that space. The other key headwind remains the regulatory environment, with the current regulations being over a decade old. Within the 10 years, a lot has changed. I mean, 10 years back, most of tobacco consumption was through combustibles. right now we have non-combustible. But by regulation, combustible and non-combustible all fall under the same category of product consumption, which is tobacco. And under that category, there is a restriction of sale. They prohibit them from advertising and promoting this brand. And BAT Kenya went back to the regulator. They paused the sale of their Velo on their online nicotine product, and they went back to the regulator to review this. And as it stands, last year they were selling some of their machinery, just that aspect of remaining asset light and maintaining high return on equity and return on asset model. They sold most of the machineries that were purchased for modern oral nicotine production. And currently they are reviewing this. We believe once they get a regulatory framework that aligns with the trends within the tobacco industry, this stock will become uh, market happy. And we might see it going back to the valuation levels of 500, 600, because the discount to the levels of 370, even without the online nicotine uh, product within the top line, still is a very heavy discount because our fair value estimates of the business is around 460. So at current price levels, still doesn't make sense. But then with Velo in play, when we did that sensitivity analysis, the 460 will jump to prices of 550. And we believe this is a very strong buy for long-term oriented investors, not to mention its dividend proposition is very good for dividend oriented investors too. Within the industrial gases space, BOC remains a key player with a buy recommendation from our end. First, looking at the industrial gases in the sector. It's a sector that is made up of small and medium-sized businesses. If my memory serves me back in high school, I remember we'd see lorries bringing LPG for laboratory use. It's only until I got into campus that I learned, oh, the two key players, BOC and Kabasi. But then there were just random lorries coming in because it's a sector that is flooded with small and medium-sized businesses selling industrial gases. So that aspect of more producers means price becomes sensitive. And with price becoming sensitive with prices, it means it reduces the margins within this sector. If my memory serves me well, BOC in the annual report are actually concerned with the industrial gases sale. But then they moved in with helping the healthcare sector setting up oxygen gases, and that has remained a very profitable business for them. And in the long run, we expect the medical oxygen supply across the country to increase, and with them being a key player in this market, we see better dividend propositions in the long run. And oh, I still have agriculture. In the agricultural space, this being the largest GDP contributor in Kenya, we think the government will actually work towards seeing the betterment of this sector, more so from that aspect of small farmers. But then from that drive, in the long run, we expect the large manufacturers the large farmers to benefit from it. Case in point, uh, I think it's crap, but the importation of agricultural machinery used to be tax free because majority of the farmers are small scale farmers. But this benefited the large scale farmers because they were able now to import the top tech machinery and do better production volumes in the long run. In 2025, from a weather perspective, there is an outlook that the East African region will experience warmer than normal temperatures with lower than normal rainfall. And this we think will affect the sector as a whole. But what remains key is sustaining, which is our focus within the agricultural sector, is heavy on irrigation. So this is largely neither here nor there. But then from a price perspective, we expect the sector to benefit from what's happening globally, with Brazil production levels on coffee expected to be low. This should really actually play on that price perspective. Same case for tea. with the probability of China actually being affected by La Nina within the year. So on Sasini, we have a buy recommendation based on the price perspective.
Thank you, Wesley, for the comprehensive overview of the markets. I hope you can hear me. So my name is Melody. Oh, sorry. Okay.
No, I was just gonna say yes, we hear you good.
Okay, thank you. So I won't take too much of your time. I'll just have a very quick overview of the banking sector. So generally, this is just an overview of the key metrics that to look at when you're looking at the banking sector. The return on equity, how much money is a bank actually generating from the investment that has been made by shareholders. And for each of these metrics, I've put a definition down there. So in general, we mainly see that there's still opportunity in the banking sector industry, especially given that the banks are still the main source of credit to the private sector, not like the developed countries where the private markets are quite deep. Here it's still nascent, but banks are still playing a very, very key role in the economy. So what I've done, I'll just look at the overall trends in the sector, though I have given company-specific reasons why we propose investment in various banks, but I'll just do a high-level overview. So basically, in 2024, what we've seen is that the banks have been really resilient in terms of their profitability, and mainly that's just due to the growth in interest income. Banks, as you know, make their money from charging rates high, or not necessarily high, but providing loans to the market, and they get their own return from that. So what has been happening due to the risk-based pricing model that has been implemented in the country, banks have been repricing their loans, especially due to the interest rate hikes that we saw by the CBK during the period. And with addition to that, banks have been putting their money into government securities. As you've seen, bonds have been paying quite a high interest rate, coupon rates, which Stella will go into later, but that also played a key role in the profitability of banks. Notably, their balance sheets, when you're looking at the customer deposits, they actually showed a bit of a contraction, but mainly that was due to the FX effect. We saw that the shilling was quite strong last year, and right now it's still relatively stable. So there's some lenders who had some very large foreign currency deposits, and that was one of the impacts. But generally, most banks have very strong fortress balance sheets. With regard to lending, which is the main business of banks, it has been on a downward trend for the whole of last year, and it actually contracted in December. And that has prompted the moves that we've seen by the CBK, which I'll go into later, but they've been cutting the central bank rate. I think this is the fourth time now. And yesterday they also announced, or the day before they announced, that they're going to reduce the cash reserves ratio so that it can release more liquidity in the economy and actually prompt banks to lend out more to the private sector. On the flip side, interest expenses have been going up. So what interest expenses are is the costs of let's say customer deposits, the costs of borrowing, and they have been going up, especially due to the competition now that banks have to compete with the central bank with regards to interest rates. So another aspect that has been key is regional subsidiaries. We've seen banks like KCB, Equity, DTB. The regional subsidiaries have been doing relatively well, as well as the non-banking subsidiaries. Guys have been going into insurance, asset management, which has really picked up, and other revenue lines. So banks are not focusing just on lending alone, but they're trying to diversify their revenue mix, so that in case one sector is not doing well, for example, like the credit sector is taking a beating, they can rely, or they can have more revenue from other sources. Another aspect is there's non-funded income, which generally deals with every other fee or revenue that comes from something that is not banking. So basically, it's been having mixed performance. So we'll send this presentation to the members in the meeting so that they can have a bit more detail. But basically, we've provided the recommendations, why we recommend the various banks, as well as the challenges that they're facing, and we've provided a link there for the full report. So in terms of the outlook, so what are we seeing in the banking sector? We're going to see some increased pressure for banks to maintain their profitability, especially with the rate cuts both locally and regionally. As I mentioned, the central bank cut rates the day before yesterday, and that's expected to release liquidity, as well as they have introduced new, we can say, supervision, quote unquote. They're going around banks to check if they're actually implementing the benefits that would get to the customers because of the rate cuts. With regards to interest margins, they might be a bit tight, but if credit demand picks up, they might see the loan volumes coming up, and that might support interest income. With the lower yields in government securities, we expect that now that crowding out effect should become less, and banks will actually be encouraged to lend out to the private sector. A key aspect is we're expecting some handsome dividends, especially with the resumption of KCB dividends, and it's actually paid the highest ever interim dividend in the first half of 2024. We've also seen a dividend increase by Stanbic, Stanchart. I&M also had a very rare interim dividend. So generally, due to those signals, as well as the overall profitability of the sector, we see some good dividends, and that is what we assume is making the banking sector stocks price rally at the moment. And lastly, deposit costs expected to come down, generally helping banks to manage their costs. So what are the potential headwinds that we see? Slower than expected growth rate. There's still very high pending bills that are outstanding, and this is affecting micro MSMEs. Non-performing loans are still quite elevated in the industry. And of the elephant in the room, of course, is the impact of policy changes by the US and the effect it's going to have locally. Also, there's the costs of managing risk. There's evolving cyber threats, especially from AI and data privacy concerns. There are a couple of banks that got hit last year due to fraud incidences. So that's something that's a key factor to look into. And lastly, the central bank, or rather the parliament approved the increase in capital requirements by banks to up to 10 billion in around 5 years. And by end of this year, they should be at 3 billion. So what we're seeing with that is there's going to be an increase in M&A transactions, as well as capital raising. And most likely, if there are any foreign banks that want to come into the market, they can have a look and feel of the smaller banks and see which ones to acquire, maybe if they have a niche target that they want to get into. So as we share these slides, you'll have a bit more an in-depth look into the factors that we've laid out. Thank you.
Thank
Thank
you,
you,
Melody.
Melody and Wesley. Please confirm that you can hear me.
Yes, we can, Stella.
Thank you very much, Fred. So my name is Stella Swake, and I cover fixed income and macroeconomics at Standard Investment Bank, as Wesley had mentioned. And fixed income is the other side or the other arm of traditional investments. So Wesley and Melody have mentioned and highlighted the opportunities in the equity side of investments, and I will highlight a few things on fixed income. So a bit of introduction on fixed income. This actually refers to investment securities that will provide you regular and predictable returns over a period of time, which covers the life of an instrument or a bond or a treasury bill. So the importance of fixed income securities in an investment portfolio are a couple of them, but I have highlighted just a few. And number one of them is stability. And based on the definition that I have given, you get to know what you expect at the end of every period. So for example, with bonds, if you have invested in a bond, you expect to get a coupon, that is the return, twice a year for the rest of the life of that bond. So if you have a 5-year bond, you will receive coupon payments twice every year for the 5 years that the bond will be in life. Number two, we have the issue of income generation. So fixed income securities provide steady cash inflows, yeah. And this is again ties to the first point in that you get to know what interest you receive. So for example, for bonds and basically fixed income securities in Kenya issued by the government, you get to know the interest immediately after the auction. So when you get an 18% coupon at the beginning, this is the amount of money or the percentage of interest that you get over the life. So you get an income generation which is stable and predetermined, and you know it. And then there's number three, the aspect of diversification, in that these particular instruments provide diversification from other securities in the traditional investment landscape and also in the alternative investment landscape, which includes things like spatial CIS, and we will look at them slightly in like 2 or 3 minutes later. And then we have the issue of capital preservation, because for bonds or fixed income securities, you get to have your investment at the maturity of this instrument. So your money doesn't go anywhere. Unlike equities or stocks, you do not gamble with your capital. So for fixed income securities, they are very, very suitable for people or investors with a low risk appetite or risk averse investors. And that's why we have this aspect of capital preservation. Next slide, please. Yeah, so here we have a couple of definition of terms on fixed income securities. I have mentioned a couple of them. Principal is the amount of money that you put in this bond at the beginning. And this is the capital that you put in. So if I buy a bond worth 1 million, my principal is the 1 million. And then we have the coupon, which is the interest rate on the principal amount that you pay, that you get paid in regular intervals. So the 18% I gave an example with, that is what you get as a coupon. So basically a coupon is an interest. And then coupon should not actually be confused with yield. Yield is also a rate, but this is the rate that is used to determine the price, for example, of a bond. Then we have maturity, which refers to the period or the time when your bond or your instrument gets to mature. So we have different levels or different ranges of maturities. And for Kenya, our bonds range between 2 to 30 years, but the effective tenor currently is between 2 years and around 22 years. And then we have the yield that I have just mentioned. So this one fluctuates over the life of a bond, and it basically determines the price. So with bonds, for example, I'll use bonds specifically because they are the most common types of fixed income securities. And I will use bonds in the case of government issuances or government securities. So bonds are traded also in the secondary market because they are listed on the Nairobi Securities Exchange. So when they are traded in the secondary market, the rate that determines the price of these bonds is what we are calling the yield. So the yield fluctuates over time, unlike the coupon, which is the same for the life of the bond. And then the redemption, this is the repayment of the sum invested to the investor by the borrower. So this is the amount of money that you get, basically the capital that you invested. Next slide. Yeah, so on fixed income securities, we have different types. And number one of them is government securities. Number two, we have corporate bonds. So the difference between government securities and corporate bonds is that government securities are issued by the government, while corporate bonds are issued by companies. So for government securities, we have two types. We have treasury bills and we have treasury bonds. So the difference again between treasury bills and treasury bonds is that the treasury bills are short-term and these ones are issued at a discount, and then you get the whole principal back at redemption. So for example, I invest my 1 million in a 91 treasury bill. So we have three types of treasury bills in Kenya and in most jurisdictions. We have the 3-month paper, the 6-month paper, which is the 182 paper, and we have the 364-day paper, which is the 1-year paper. So we have the three. So for example, I invest today my 1 million in a treasury bill. The rate at which this money is invested, say I invest it at 10%, then I'm required to pay 990,000, if I'm not wrong, 990,000, and then I will get back my 1 million. So the 10% is usually a discount.
Hi, Stella. You seem to have dropped off. Could you kindly reconfirm if your sound is working? So as Stella is logging back in, so as she mentioned, T-bonds. So these ones are the ones that are relatively long term, that have a maturity of above 2 years. And with that, it's mainly suitable for investors who are looking for stable and long-term returns. And in Kenya, there are basically two types. There's the infrastructure bonds, which are tax-free. However, new bonds will start attracting a 5% withholding tax, but considering everything, it's still a relatively attractive instrument to invest in, as well as the second type is a fixed coupon treasury bonds. These papers tend to be less than 10 years. However, the key to note is that they attract a 15% withholding tax, and those with that are 10 years and above charge about 10%. So actually, a better part of the reason why the bond market was performing quite well is the high rates or the high coupon that was on offer last year on the infrastructure bonds. So you can imagine if you're getting about 18% interest relatively, it was tax free. So that's why even the banks were, instead of lending out to the private sector, they targeted to invest in the government securities. So how does this process actually work? So when government securities are on offer, they go through an auction process, which is conducted by the central bank. So everybody submits their bids and they specify the interest rates that they're willing to accept. And that leads to something called competitive and non-competitive bidding options. Competitive, I think there's a certain level of money that you need to have. I believe it's about 20 billion and above. 20 million and above, sorry. And non-competitive is below that. And the minimum amount for the infrastructure bond is 100,000 Kenya shillings, while for the FXD, it is 50,000 shillings. Notably, the interest rates are determined by market demand as well as the MPC, the monetary policy. So you can see with the rates, CBK, the way they have been cutting their rates, that will drive down the rates that the coupons and the rates that will be on offer in the primary markets. Something very important to note is that there's inflation risk because the returns are fixed. You may lose value if inflation is rising significantly. But key to note is Kenya, for the past couple of months, has had a relatively stable inflation rate, which is below 5%. So that's something to consider. There's also the aspect of interest rate risk because bond prices fluctuate. So that can lead to a bit of volatility with regards to the bond price. and as well as reinvestment risk. So there's an aspect of it being difficult to reinvest returns at similar rates when there's falling interest rates. For example, if you bought something at if you got getting a coupon of 18% last year, this year it will be very hard to get something of a similar rate of return. So the other aspect is corporate bonds, though they are not very many. They are still in our capital markets. They've not gained as much traction. But there are some new areas, like we had a green bond recently, and so the capital market is looking for ways to bring into innovation into the types of instruments that are being offered, so that it can spur capital growth. I won't go too much into the corporate bonds. So unit trusts, I'm sure this is where most of the interest is. So I'll ask Wesley to just take us through it very high level and briefly, so that we can answer any questions that you may have.
Melody, I came back. I can continue. I'm sorry, guys.
Okay, please continue. No problem.
Yeah, internet issues, but yeah. So thank you very much, Melody, for holding fort. So unit trust funds are the main class or the main arm of the collective investment schemes. We saw that you mentioned that you want us to mention or highlight something on unit trusts. So this is a class of investment that offers different investors a pool of investment for them to actually invest in other asset classes or not take the trouble or worry of worrying about managing funds and doing all this by using a fund manager to do all the investing, all the analysis for them. So we have a couple of unit trusts in Kenya, but the major ones are basically money market funds, balanced funds, but the one that you'll hear most is the money market fund. So for unit trust funds, this is the distribution of where they have allocated their funds, and most of them allocate their money on government securities here in Kenya. So that is followed by fixed deposits in banks, and then we have cash and demand deposits, which we also call call deposits. And there's a small percentage that they put in offshore investments, and then a smaller one in unlisted securities. So these could mean private equity. We also have listed securities, much of what Melody and Wesley highlighted. And then we have immovable properties, which basically speaks to real estate and other collective investment schemes. And this could speak to alternative investments. Next slide. So yeah, I had mentioned that we have a couple of CISs or unit trusts, money market funds and balance funds. We have equity funds, we have alternative or special CIS. So these ones, we have a couple of them, but the major special CIS that we have in the Kenyan market at the moment is the Mansa X and another one offered by Oak Fund. So offered by Faida Investment Bank, which is called Oak Fund. But today we will actually highlight on the Mansa X, which is offered by SIB. And Wesley gave a good highlight of who we are in terms of what we manage and who regulates us. So we are regulated by CMA, and we are also regulated by, or we have a license from RBA that allows us to manage pension funds. So for Mansa X, it's a very interesting product and a good product for an investor who wants to access or have an exposure in the global space, because Mansa X greatly invests or diversifies in global investment. So what I showed you in the previous slide, that chart on where CISs allocate their monies, you've clearly seen that the CISs in Kenya or UTFs allocate their money mostly in government securities. But when you come to Mansa X, there is a lot of value proposition in terms of capital preservation, Number two, diversification, and especially in the global space. We also have the issue of a very good and attractive return of about or between, which averages between 18 and 21% over the life of the fund, which was brought into inception in 2019. So here we have highlighted the key features of the fund, number one of which is we do not charge any fee, initial fee or redemption fee. You can actually withdraw your money without being charged anything. Number two, we charge a 5% annual management fee, which is prorated over 365 days, which means if you invest your 1 million today and you want to withdraw this money 6 months down the line, you will pay 5% over 365 times the number of days in 6 months. So it's actually prorated. Then we have a 10% performance fee applied for a return and above 25%. So this is only applicable when we surpass the 25%. So actually it offers some form of motivation for the fund manager to achieve or to deliver better returns for the client. We also have a 6-month lock-in period, which helps the investor at least to realize some form of return, because it doesn't make sense for an investor to put in money today and withdraw that money next week expecting a return. So we advise a lock-in period of 6 months. And then we have quarterly statements and valuations for our investors. So if you invested or our clients, so you get a statement for where you are, how your money has grown. And we also do fact sheets, which try and update the clients and investors, and as well potential clients and the general market on what we have invested in. So we basically invest in euro bonds. We do commodities in the global space, commodities like gold. We do wheat, we do sugar, all of these commodities that we find opportunities in. And finally, we have a regular global markets commentary. We have a dedicated team that actually gives updates on what is happening in the global space and tries to analyze and get opportunities where the fund can make money. Next, Wesley. Yeah, so the benefits of global markets exposure, as I had mentioned, the Mansa X Fund by SIB does global investments. Number one is that it offers a diversification from traditional asset classes like bonds and equities. You get to diversify your portfolio by adding Mansa X onto it. Then we have 24-hour market, whereby because of the nature of us investing in different markets and the timeline differences, you get to witness or experience a 24-hour market whereby you can actually invest at night or during the day, like you can get the updates all clock round. And then dollar return in terms of when the shilling appreciates or depreciates. So when we have a depreciation, we get to have that dollar return, especially for our dollar fund. And I forgot to mention that the fund has three arms. We have the dollar fund, the Kenya shilling fund, and also the Sharia compliant fund for the people that are sensitive to these matters of interest and all. And then we have it leverages on trade amounts larger than your capital, because we are pooling funds from different investors. And also let me mention that the fund has grown significantly to around 40 billion as of the last quarter. All of the three funds, we have around 40 billion for it in terms of AUM. And then you get trading opportunities, there's liquidity. It's also a value proposition point for Mansa X, because you get your money within 2 working days if you follow the instructions very well. And this is actually aided by our financial advisors who help in advising and telling our clients how to withdraw and how to follow instructions strictly. And then we have a local presence, so both online money managers and online brokers based in Kenya. So you can get to our offices, and if not, you can get, you're able to get us and catch us anytime you'd wish to. So these are the account opening requirements. For KYC, we always need an ID, a KRA PIN, a colored passport photo for the applicant or the client, a proof of bank account ownership, which includes ATM cards, That is the front page only of the ATM card or the bank statement. And usually the top page, which gives the details of the clients, usually suffices. You don't need to show us your money or your transactions. And then also we have a cancelled check, which you can use to prove that that is your bank account. I'm sure we've taken much of your time, and apologies for that. We had a lot of things to tell you, and I really hope that this has been helpful and very informative to you, Fred, and the team. So I'd love to open this stage for you for a question and answer session whereby you ask us what. Yeah, go ahead.
Thank you so much, Wesley, Melody, Stella. Just general feedback. Everyone says you guys know your stuff very well, very confident. People were really impressed. Just in the interest of time, I will ask very few questions. And if there's more time, if you guys are still here, these guys online will ask as many more as they want. First question was on the equities. I think it was Sassini. What's the link between China and Kenya tea? One of the respondents mentions that China consumes about 95% of its tea locally, whereas we consume maybe 5%, but we do not sell our tea to China. So the guy is trying to understand what's the link between China and Kenya's tea.
Yeah, I'll take that. Yeah, you're right. Actually, most of China's tea is consumed locally, but they also have that aspect of export. And still, when you look at it from that local consumption, if this La Nina condition comes in and impacts the volumes, then there'll be a deficit from a demand perspective, sorry, from a supply perspective, and that will create either a need for importation of tea or rather a reduction in the volumes of tea that they'll be exporting externally. Either way, that shortage of supply will play around with the demand and the pricing aspect from a demand and supply dynamics, lifting the prices relatively higher from a point of view. That's the play that you're counting on, similar to what you're counting also on coffee.
Yeah, that's well understood. The next question I have here is, what's the impact of non-bank lenders to bank lending? I think that was on Melody's presentation. What's the impact of the non-bank lenders on commercial bank lending?
Thank you for the question. As of right now, it's not that major. Yes, they are a growing cause of concern, but as I said before, banks are the main source of credit for the private sector in the industry. And right now, maybe what you can see is more of partnerships with fintechs and insurtechs and all the other innovative providers that are coming up. But in my view, currently at the moment, banks are the main source of credit to the industry. Yes, there's a growth of the private debt markets and the, as we said, mentioned about private capital raising and such. But generally, banks are still the main source of capital in the market.
Okay. Another question, which is now on fixed income. Have the withholding taxes on the infrastructure bonds become law, or is it still a proposal? Have the withholding
Thank you, Fred,
tax
for the question. Yeah. So this was implemented in the Tax Laws Amendment Act that was signed into law in December of 2024, and it followed shortly after the withdrawal of the Finance Bill 2024. So it was still included, but it will apply for new bonds that will be issued from now henceforth, not reopened bonds, only new bonds. Yes.
Okay. Another question still on fixed income is, what is CIS?
Okay, I think I mentioned, but it's okay. I'll just repeat. It means collective investment schemes. So just from the name, the pooling of funds from different investors and then investing them as one amount of money.
And the final question I have, on the account opening, can the bank account statement or the card be an Australian bank statement or an Australian card, or must it be a Kenyan one?
Not necessarily. It can be a bank of where you are, But then you'll have to indicate, there's a place on the forms that ask you whether you're a Kenyan nationality or a foreign nationality. So that is sorted there. But again, for you to, it's more of a logistic issue when you have a foreign bank. But if you have a Kenyan bank or a local bank, it will be easier for you. But all are still doable.
Just someone asking the same. Does a SACCO account qualify as a bank account, or someone must have an actual commercial bank account?
No, a SACCO account doesn't qualify as a bank account.
Okay, that's all the questions that have been sent to me. I don't know if anyone else in attendance has a question or comment, compliment, complaint.
Just to add on to what Stella was mentioning, in case somebody is interested in buying shares and they don't have a CDSC account or CSD account, on the slides we've provided the information, but that one you would require to have an account domiciled in Kenya. Unfortunately, that one you can't use an account outside. The other option is if you have a bank account with banks like ABSA or StanChart, you can open a custodial account.
Okay. Does anyone else have anything to say? Is anyone in attendance? Okay, I'll take that as a no. We're just 10 minutes overboard. Thank you very, very much, Wesley, Melody, Stella, and the greater SIB community. Thank you, Caroline, Mo, Colin, for attending, and everyone else in the background. And I guess Colin's clapping for SIB. Really appreciated it. This brings us to the end of our webinar. Once I get the slides from SIB, I will definitely forward to everybody. Any questions, I will make sure I highlight SIB's email or contact details that they give to me, and you can contact them directly. Thank you so much. The guys in Sydney or in Australia, have a good night. People in Nairobi, have a good afternoon. Goodbye.
Thank you. Good night.
Have a good one too. Bye.